Good morning, ladies and gentlemen, and welcome to the introduction to Lords Group Trading PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet company dashboard, and we will notify you by email when these are ready for your review. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Shankar Patel and CFO Chris Day. Good morning.
Good morning, everyone, and welcome to our Investor Meet company introduction. My name is Shankar Patel. I'm the CEO of the business. I've been a shareholder since 1993, the MD since 1999, and when we formed into a group structure, the CEO in 2009, or since 2009. I have led the group in its growth from revenues of 1.8 million in 1999 to 360 million in 2021. My educational background is an economics degree from the London School of Economics. I then went on to law school, did a conversion course as well as my Law Society finals. But the educational background that I'm most proud of is the opportunity to attend Harvard and carry out the Exec Ed course of the OPM, which is Owners President's Management Program. In the industry, my profile is through our one of the main buying groups, HMB, which is where I'm a designated member, and it's one of 4 buying groups leading our industry. The other membership is the directorship of Builders Merchants Federation, which is the only trade body representing merchants and suppliers in the material supply industry. I'm joined by Chris Day, our CFO, and I'll let Chris let you do his background.
Good morning, everybody. So I joined the business at the beginning of 2017. In terms of prior experience, academically, BA Honours degree in business and finance, and SEMA qualified accountant, and have a MSc in supply chain management. Prior to joining Lords, I held a number of senior finance roles, latterly at Travis Perkins, a couple of different roles, but I was finance director of one of the divisions in the group at the time. Prior to that, I was in fashion retail with Monsoon Accessorize and third-party logistics with Clipper.
So a bit of a company overview. We classify ourselves as a leading distributor of building materials. We have been established for a very long time. The origins of the business go back to 1985. What you see on this slide are the sort of main information blocks about our business, our revenue, our EBITDA. But if I can focus you firstly to the right-hand side, which is our 45 great locations, and then onto the left, our 880 employees. The reason why we focus on these 2 items is that our business is basically a business where we have great managers or general managers running these 45 locations. We believe in investing in them so that they are the local leaders in each of these locations where we trade. And we give them entrepreneurial freedom within a framework. Effectively, what we call them are mini entrepreneurs running their own business. And they're supported by 880 very highly engaged, exceptional colleagues. Our business is run on a simple equation. EE equals HC equals SS. And that simply means that an engaged employee leads to a happy customer, and a happy customer leads to a satisfied shareholder. And we've built our business based on that very premise. Some of the other things to call out in our business is the fact that our IPO was oversubscribed in July 2021. We are highly cash generative. We're in the RMA market where 80% of our turnover generates from, and it's still a strong market despite the headwinds that we see in front of us. And as I said, our aim is to be a local leader in any business or location that we trade from. Overall, we intend to become a £500 million turnover business by 2024, with a focus on e-commerce and technological initiatives. On the next screen, you'll see our various brands and the group, which is divided into 2 divisions. One is merchanting, represented by all the brands that you see on your screen, the original one being Lords Builders Merchants and Lords at Home, and then several that we've acquired along the way and grown. And on the right-hand side is plumbing and heating, a larger division with revenues of 233 million and adjusted EBITDA of 10.2 million, and with 6 strong brands, 2 of which are online e-commerce brands and leading brands in their field, namely Columnrads and Mr. Central Heating. The history of the group is one where there's strong organic growth as well as acquisitive-led growth. As you can see in this infographic, our first acquisition was actually made in 2003, long after we had established ourselves in 1985. But in between, we'd opened our heavy side business with Lord's Builders Merchants in 2001. And then from 2003 until 2013, again, we grew organically. Since 2016 is when our acquisitive-led growth has really been spurted, and over the last 3 to 4 years, we've made multiple acquisitions. We're very proud to have returned an ROI in excess of 20% on most of our or all of our acquisitions. A little bit more about merchanting. So the business currently is 132 million in revenue with 8.2 million of EBITDA across 30 locations. Now, what's really different about this business is its major focus or sole focus on customer experience and customer service. We call ourselves customer-obsessed product specialists. And the reason why this is important is because the customers that we deal with need us to be product specialists. They need a wide range of products. They need speed of delivery, and they need credit. Now, all of this allows us to pass through price increases and maintain our margin, because what we're offering our customers is a value-added service rather than just selling them a commodity such as cement or bricks or blocks. We have a highly experienced management team built over a number of years, 580 great employees, and one of our core strengths in this business is that we really invest in our fleet. We've got a 100+ strong fleet. As deliveries are absolutely critical to our customers. Getting products to them either same day or next day is vital in the chain. And we've also invested heavily in technology in order to enable our delivery service to be the best that it can be. We're one of the only merchants that provide a real-time tracking with deliveries on building materials. Travis Perkins, one of our competitors, now recently launched their delivery tracking service, but we were one of the only merchants for about 18 months that had this service. And this allowed our customers to plan offloading our vehicles on site around the time that they knew the vehicle was going to arrive. And it sounds pretty small, but when on site labor is the most expensive element, this service that we provided was invaluable and is invaluable to our customers. We're also part of a strong buying group, so we have good buying synergies coupled with other merchants. And lastly, what we really believe in is maintaining our premises. We've got 30 great premises that are very well maintained. Next is our plumbing and heating business. As I said, it was the larger part of our divisions with 233 million in revenue. Now, this business focuses on delivering to other merchants on a next day basis, again, through a very strong 70+ fleet of vans. It's one of only 2 boiler distributors in the country. There's us and a former Travis Perkins owned business called F&P. And it's vital in providing the plumbing and heating supply chain with a route to market for boilers. And therefore, we believe there are high barriers to entry. But in addition to distribution, we also have our own merchants. Out of our sites, at the front is a trade counter, so akin to a plumber's merchant. At the back is the warehouse where we distribute from, and in the cloud is our e-commerce offering. Now, having a multi-channel approach allows this business significant synergies in maintaining a lower cost but a higher output revenue line. We also see significant organic growth potential here with more locations. Mr. Central Heating has only got 9 locations at the moment. Our nearest competitor has 300. Sorry, our largest competitor has 300. We have identified many towns and cities that we could open up more Mr. Central Heatings, and we'll be doing so in the coming months and years. I'll move on to Chris now to talk you through some of our market size and financials.
Sure. Thanks, Shanker. So The market is very substantial, 76 billion, and within our addressable market, 55 billion of the 76 is addressable for us. So Lords today represents less than 1% of the market. We believe that the fundamentals in the building materials trade are very favourable for a number of reasons. There's very strong demand for new homes. There's a significant volume of housing transactions occurred over the last few years and continue to do so post the pandemic. And we see huge pent-up demand through the existing housing stock of 27.8 million homes for two reasons. One, the standard of maintenance is only satisfactory in 36% of the UK housing stock today. And secondly, we see an acceleration through the drive for energy efficiency across the housing stock. This next slide gives you a view of how we're structured within that market. So predominantly RMI focused, it represents 80% of group revenue, something we've done very intentionally over the last few years for three reasons. Firstly, we believe that demand is more inelastic in the RMI space, particularly in the R. So for example, we supply boilers and heating products in our plumbing and heating division, and it doesn't matter what pressure is going on in the world. Today it's tension in Ukraine and interest rates and inflation. But we believe if a household was to lose heating and hot water, they would do something about it very quickly. So that provides a reasonable base of inelastic demand. Secondly, we believe demand is pent up for the reasons outlined on the previous page. And thirdly, we see RMI as the highest performing category for three reasons. One, the margins are richer, so there's more ability to add value to the supply of building materials in the RMI space. Two, it's better diversified. So there's no great concentration in a single customer, supplier or product category. And thirdly, for the builder, we can add value in the supply of materials. This slide gives you a view of how the market is structured from a competitive perspective. Broadly today, the nationals make up just over 50% of market share, and they are largely no longer acquiring or, if anything, consolidating their position in the market through a number of disposals. That's created an opportunity for the entry of private equity, which make up 8% and growing of our market. And to date, really, certainly from a trading perspective, no adverse reaction to their entry into our market. Our focus is very much on the 40%. That's the independent merchant. That's the opportunity for consolidation. And you've got thousands of small independent merchants, anywhere from 1 to 10 sites, normally 1, 2, 3 sites, and they're the target for consolidation. So they have some common traits. It's an aging demographic of ownership in that 40%. They're not investing in new technology to drive the business forward, and often lack succession planning, either within family or small limited management teams. And that's an area that we've managed to consolidate very well over the recent years and continue to see opportunity going forwards. So if acquisition is one angle for growth, and Shanker will talk through both of these in more detail with some case studies shortly. The second one is organic, and we still believe we have a great opportunity to grow organically. We've developed a platform and a set of brands that are capable of scaling nationally through increased coverage across the UK, or by extending and deepening their product range to existing customers. And thirdly, by using our in-house digital expertise, we think we can grow our share online substantially. So if I was to pick out a couple of examples to bring this to life for you, Mr. Central Heating is a brand you saw on the first couple of pages. It sits within the plumbing and heating division, 50 million of revenue, 35% is online today. It operates out of 9 locations. So a national website with national next day delivery from 9 locations. We think there's a great opportunity to expand that geographical coverage. It's a business that drives accretive EBITDA returns and favourable return on investment, and it's an example of how we could grow one of our existing brands. The second example to call out is around product range and offering. In our merchanting division, 15,000 products sold annually. We think that we can extend that substantially. We underpunch versus our national competitors there, and what extended product range brings is very often margin accretion, and also allows us to supply a greater share of each project that our customers are working on. A view of some numbers. So you can see strong and steady progression over the 6-year period. Revenue in the left-hand side rises from 157 million to 363. EBITDA over the same period from 4.3 to 21.5. It does pivot through to IFRS through that period, but FY21 on a pre-IFRS basis is 16 million. So you can still see very strong progression over that time period. Focus on the two divisions individually. Plumbing and heating represents the orange blocks in this graph. That's 100% organic growth that's been driven through there. So the business has gone from 112 million up to 233 million, led through geographical extension and product range extension. So some prime examples of from the previous page. Merchanting is a combination in the blue boxes of organic and acquisitive led growth. And across that journey, you can see improving EBITDA margins. We think EBITDA margin continues to be an opportunity for the group. So through product range extension, digital expansion, accelerating the growth of our higher margin brands, and through operational leverage, we think we can continue to grow that margin. And as you head out to FY24 and the ambition of 500 million, we'd expect to be adding another % onto our EBITDA margins as they stand today. I guess a bedrock of the group is to drive cash flow. So we're very disciplined in the way we allocate our cash. Firstly, through tight working capital management. So we look for cash from operations to be about 80% of EBITDA. That allows us to then invest into growth. So organic growth through product range extension, new sites, digital, or through acquisitions, or our promise of a progressive dividend. All of that together drives the growth story. Some of you will have seen we issued a trading update on the 26th of April. So I'll cover this quickly before I pass you back to Shanker. We are at this point very comfortable with the integration of the 7 businesses that have been acquired through FY21 and into 22, and are continuing to trade in line with market expectations for FY22. Revenue growth of 13.5% in the quarter at group level is split between merchanting and plumbing and heating. Merchanting 16.8% like-for-like revenue growth, which we're very pleased with, and total growth of 79.3% when you factor in the acquisitions year on year. Within plumbing and heating, negative like-for-like growth of 12%, driven by some availability constraints in boiler supply. They started in Q1, are expected to conclude in Q2, but ultimately one of our lower margin product categories, and we expect to deliver market expectation and have pulled levers to address the decline in revenue. I'll pass you back to Shanker.
Okay, so we mentioned that our growth strategy has 2 elements to it, an organic element and an acquisition element. And what we look at in terms of our growth strategy is more like a flywheel concept. We drive organic growth in all of our businesses through investment, which provides a strong platform. That investment spurs on growth. That growth leads to free cash flow. We then take that free cash flow and either acquire businesses, or once again we reinvest in other locations, and the wheel keeps moving in that particular fashion. So with investment, we then in addition have multiple brands which we can roll out, and as Chris mentioned, One of them is Mr. Central Heating, which is only 9 locations, and we see a market for at least 50 over the coming years. There is also George Lines, which is the civils brand. We've recently opened a 3rd location in the south of England, and we see at least another 5 to 6 of those depots that we can spread across the country. We also have our investment in our digital platforms and our logistics. I spoke briefly about the fact that we want to provide our customers with a technology-led solution to them building material requirements. And again, our strategy is to invest in these areas so that we are the merchant of choice that not just provides the product, but provides that overall experience that adds tremendous value to our customers. And then we also see that really our market is driven by house building and RMI, which is expected to continue. One of the key factors that we tend to, or key indicators that we tend to focus on, is housing transactions. We're a firm believer that housing transactions invariably lead to requirements for building materials, be it paint, because you bought a new house and you want to repaint, be it larger projects such as new kitchens, new bathrooms, extensions, or be it full-scale refurbishment. It's these transactions that generally lead to a sustainable RMI market that will continue to grow. But we also see commercial areas of organic growth. With the advent of EPC requirements on commercial buildings, we believe that the commercial building stock will also go through a fair amount of investment, as landlords and tenants need to start investing in their premises. So overall, our market expectations are that we will see a 5% year-on-year growth. But allied to that is our unique acquisition strategy. And the reason why we say it's unique, because there are 2 elements that we firmly believe in our discipline in acquiring business. Firstly, that most people acquire businesses and then get the integration wrong. So for us, integrating a business is key, which is why we're always interested in making sure management teams are retained, the business is invested in, and people are incentivized to perform. But the other element is the fact that when you make an acquisition, there is everything that you can change about an acquisition the day after you've bought the business. You can change the name, you can change the product, change the location, change the people. But the one thing generally you can't change is the price you've paid for it. And for us, that is the main element of our discipline, is we never want to overpay. And we have a unique way of ensuring that we don't overpay. And that is by ensuring that we get into a collaborative sale purchase process. If a business is up for sale through a process, through retained agents or corporate finances, generally we will stay away, or we will engage early on only to then take that engagement into an exclusivity. And we can do that because we're very experienced at understanding what sellers really want. And quite often they don't just want the best price. There are many other situations that we've come across that are of interest to sellers. Some being succession, when they have children or family working in the business. Invariably, a lot of them have property elements, which they either want to keep or want to dispose of. So again, we provide a solution-based approach to this. And this sort of approach, this very personal approach, there is a saying that if people want to sell their business to Lords, the first engagement is to have lunch with me. And that is true, because barring the pandemic, every time we buy a business, the first thing I insist to a vendor is we must meet for lunch or dinner. And I do that because that's when you really understand the culture of the business that's been created by the people who are trying to sell it. And from there, we understand what we're buying and how we can then integrate that business. And some of the key aspects is that we are targeting acquisitions on a 3 to 6 times maintainable earnings basis. Recently, we're also making sure that we check that we're not buying at the recent highs, because we have had a post-pandemic boost, but we average out earnings over a period of time, and then also ensure that we're not paying for future opportunities that are for us to take the rewards from. And as I say in this bullet point, we are very, very keen to ensure that you do not overpay, because you cannot change the price of an acquisition once you've made it. On the next slide is a case study of a business that we acquired in 2017. At the time that we acquired this business, revenues were 2.5 million, and it was loss-making. Revenues were falling very fast. The family that owned the business, there were 4 cousins, all of them were warring or fighting with each other, and then therefore the business was really rudderless and leadershipless. In the 4 years under our ownership, the revenues have increased to 7.9 million. But more importantly, what you see on the screen is an image of a completely transformed site. The building at the front is a building that we've just recently finished. It was a project that we started really about a year after we acquired the business. The whole site has been concreted. It wasn't concreted. We've put in a huge amount of infrastructure, new plant, new machinery. All of that has allowed this business to, triple in revenue. It's increased its earnings by a significant amount, with more growth coming. The 2024 growth forecast shows that this business can reach revenues of 15 million with a 1.6 million EBITDA. So this is part of our flywheel model. Buy a business, we invest in it. That spurs on the organic growth. We take that organic growth and free cash flow and invest in it again. And the proposition that we talked about earlier, about extending the product range, extending our capacity, having an experienced team, all of that you can see with a business such as this, which we acquired at the time it was loss-making. The next case study is of a multi-site business that we acquired, very similar to the one that I just mentioned, in a similar geography. There were 3 merchants that we acquired in September 18, and through, again, our work in enhancing performance, we have a 41% return on investment in year 3. The challenge for this particular vendor was the fact that he had a succession issue. He did have a son in the business, and he would like to have that son remain in the business. I'm proud to say that he's still with us, almost 5 years after the acquisition. We've retrained him from being a salesperson to being an HGV driver, which was his life's ambition. The business was underinvested, and we've again invested in all of its sites. And as a result, we can see the performance of this business. When you look at the revenue line, it's 7.6 in 2018 at the time of acquisition, 18.5 in 2021. The earnings, 0.02, has increased to 1.85 million. I mentioned earlier that in our acquisitions, we're also very keen to provide non-price solutions. And in this particular case, the vendor was very keen to keep the properties. The properties were owned by his pension fund. And the deal that we did was to give him 20-year leases, thereby significantly adding value to his property estate. But in return, we managed to get below market rents. So what we call a win-win. The sites that we've got have excess capacity, and we've already put in 1 implant, which is a George Lyons implant, into one of these sites, and now we'll be putting in another roofing implant into one of the sites as well to drive further organic growth. These are the recent acquisitions that we've made. So at the time of IPO, we had always said that we have a significant number of acquisition opportunities. Again, all of these acquisitions that you see on the board are non-process-led acquisitions, starting with AW Lum, a significantly sized business of 43 million, specialist dry lining and insulation distributor. And it's got a fantastic management team that is retained and will be running the business in conjunction with us. We believe we've paid a fair value for the business at 4.2 times multiple. And the business has, again, tremendous growth opportunities under our ownership, with synergies across customers, across geographical expansion, and increasing its digital presence. We then moved to direct heating, HRP trade and direct heating. That's in our plumbing and heating division. That business has revenues of 27.6 million. Again, a sub-5 multiple on purchase. Again, with a key management that has been retained. This business has significant synergies of cross-selling with APP Wholesale. So APP Wholesale sells boilers, HRP Trade sells boiler spares, amalgamating the 2 product groups and pushing it through our APP sales team we believe there are significant sales opportunities. Again, this business, like many of the businesses that we buy, has a lack of digital presence. We have a tremendous amount of digital experience in the group, and we'll be working now on providing these businesses with digital strategies to increase their sales. Bottom left is advanced roofing supplies. That was in the merchanting division to expand our product range into roofing. Again, we paid a 5x multiple, but this business is really interesting because it has a fantastic geographic and product fit with our merchanting. So we will be taking advanced roofing and putting it into 2 of our existing locations, and pretty soon it will have between 3 and 4 locations spread across the home counties. We expect the overall revenues to start growing as these synergies and the implants start to unfold. On the right hand side, the last one that we acquired was heavy building supplies. We took a divestment of a business in Suffolk from one of the larger players in the industry, Hughes Gray, that bought out Buildbase from Grafton. They had a competition authority issue on this one particular location. Again, due to our reputation, the CEO of the disposing company, Hughes Gray, called me first before he put it into the market to say, I need somebody that I can trust to buy this business. And we were fortunate enough to buy it, again, at a price that we think is very fair and offers us great margin accretive opportunities. So in summary, if I can finish with sort of some bullet points about our business. Firstly, all of our brands have strong local growth potentials. We're really focused on being, local or regional leaders in what we do. We've talked quite a lot about our growth initiatives and acquisition opportunities in both divisions. We firmly believe that we have carved out a niche in landing acquisition opportunities in the way we do, and that the fact that we are a business that wants to invest in all of its activities, and that will support organic growth. Our teams are highly experienced and incentivized. We have this customer obsession. We truly believe that through engaged colleagues, you get happy customers, and through happy customers, you get satisfied shareholders. Our discipline is strong. We're highly cash generative. We ensure and want to continue ensuring a 20% plus ROI, and that ROI and high cash generation allows us to not only fund further growth, but of course also provide our shareholders and investors with a progressive dividend. We believe our ambition is very realistic, and that is to reach 500 million turnover by 2024, with obviously a margin accretion. Finally, please save the date. On the 24th of May is our results presentation. Thank you very much, and I'll hand back over to Jake.
Shankar, Chris, that's great, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while Shankar and Chris take a few moments to review those questions submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Shankar, Chris, as you can see, we've received a number of questions throughout today's presentation, and thank you to all investors for submitting their questions. If I could please hand back to you just to run through that Q&A tab, and where appropriate to do so, if you could just read out the question and give your response, and then I'll pick up from you at the end. Thank you.
Okay.
Sure.
Sorry.
Shall I pose the questions? So first one is from Ryan N. What do you see as the greatest challenge to reaching the circa 55 billion addressable market and achieving your revenue targets?
Actually, to be perfectly honest with you, Ryan, we really don't see a massive challenge in reaching our revenue targets. I think the challenges around working in the current environment. It's an environment where you have got supply shortages, you've got high price inflation coming through. You want to make sure you'll be able to pass that inflation through. So it's an operational challenge that we face through a highly disruptive 24 months and possibly a further 24 months of different types of disruption. The market, we think, is strong. The market has always been large. We think the market will sustain itself. There will be some ebbs and flows. We're in the RMI, I'm a firm believer that improvement might be affected by what is happening in the economy, but repair and maintenance can and will continue to be required. As again, you see some regulatory changes in requiring building owners to maintain their buildings. Those markets open up. The race to net zero opens up us new markets on technology-driven solutions. So it's a question of being able to read changes in what is still a very large market, and then being able to operate through the current disruptions. Obviously, we've had the COVID disruption with labour shortages. We still have some labour shortages. Now it's moved to product challenges and price increases, and making sure that we are able to pass those through.
Next question from Mark A. What does the pipeline look like for new strategic acquisitions? Any new verticals you might look to expand into?
The pipeline is always very strong. We generally have 4 to 6 acquisition targets that we're engaged in talking to. So we don't see that reducing. I think the pandemic has brought a fair amount of vendors to relook at their lifestyle, where they are with their business, the fact that operating a business, especially an operationally challenging business like ours, with lots of moving parts, trucks, plant and forklifts, stock, etc. A lot of vendors are looking at the future and saying, what do I really want? And because of our approach of what we call, burdening owners, relieving owners of the burden of ownership, right? So we relieve vendors of this burden of ownership, and a lot of people really like sort of collaborating with us to get an outcome, and that outcome usually takes time, because we like to really take our time over the solution that we provide. So at any given time, we ensure that we're talking to at least 4 to 6 particular opportunities. And then in terms of verticals, yes, the business has always looked at verticals. If you look at our acquisition in plumbing and heating, whilst not a true vertical, it was more of a distribution business. So from manufacturers to itself to merchants, whereas our merchanting business is from manufacturers straight to the end user. The interesting thing with verticals is to make sure that there is a strategic fit. Now, vertical opportunities are not as large or as abundant as merchanting, because that is our core business. But certainly we're not closed off to looking at expanding into that as we grow our business.
Okay, next one from Michael D. APP Wholesale. You referenced that supply chains may be acutely felt in April and May. Do you feel that thereafter this impact may be less meaningful? Do you want me to start with that one?
Yeah, go on, Chris. I think
So I think Michael, as we said in our trading update, it's the impact from a revenue perspective has grown through Q1 and is expected to mature in Q2. I think that the positive at this point is that the boiler manufacturers have been aware of the problem for a while and have now found alternative components that have been fully tested and signed off. So they're confident that supply will return to normal, and it also happens to kind of supply will return to peak production levels at a time as demand tails off slightly as we head into the summer period. So they're confident of getting back on track by the end of Q2. Okay, next one, Jordan D. Hi Shankar, I can see you've been with the firm for 30 years. Could you give me a brief background of what you've done over those years?
Gosh, how much time have we got, Jordan? So I actually started as a Saturday boy with the the business. When I was at school, I used to always wanted to earn some money, so I joined the business doing what a lot of school students do when they're working, stacking shelves. That progressed to when I was at university. I needed more pocket money, so I used to go in between lectures to work. By that time, I was starting to sell, and that's what I really enjoyed. I really enjoyed serving customers. And then when I joined full time, I took over general management responsibilities. So started to then develop into recruiting people. I think I was the company's first delivery driver, and the list goes on. So really, what I've done is everything from the ground up. But it's in around about 1997 when I became the managing director that I started to look at the business from a more strategic point of view. So I made sure that we had a really decent balance sheet. I made sure I understood how to raise finance for the business. I understood many of the operational factors that go into our business around logistics, around purchasing. And then as we grew from around about 2006 onwards is when I went back into formal education. I sort of did a program at Cranfield and started learning about general management. How do you grow a business beyond it being an owner-managed business, and started to bring in professional management, and colleagues who are far better at functions than I would be. Namely, of course, Chris, who's joined here on the call. I think his challenge was when he first joined us that I thought I was still the FD, along with being the MD and CEO. So those are the sort of things that over the 30 years I've done. There isn't. I always say to colleagues, there isn't anything I haven't done in this business apart from drive an HGV. I did attempt that once, trying to shunt the vehicle out of the yard, and I stalled it about 5 times. So I very quickly got out of it and said, I'm never going to attempt that again. I am the world's worst forklift driver, but I did do my forklift driving for a period. And it's management and selling that I really enjoy the most, and along with strategy. So I hope that gives you a good flavour of my brief background in the business. I think we have a question from Simon C. Chris, perhaps.
Yeah, the final one, I think. So it has the integration of the 7 businesses acquired by Lords during FY21 now been completed, and have any exceeded your expectations?
I don't think we could say that all of the integration has been completed. No, the integration, and this is part of our model. What we find is that if you integrate very quickly, you run the risk of unsettling the business that you've bought, right? Because culturally, I always say people want to believe in something and believe in someone and belong to something. And at work, you kind of belong to the business that you're learning to belong to the business that you're working for, especially when you're long-standing colleagues of 10 years plus. So there's that culture that is created around the business, and that culture is created by the vendor. And when an acquirer steps in, the colleagues are quite nervous around the changes that will be implemented. And so what we tend to do is we tend to test the temperature, ensure that we integrate, but integrate using a timeline that will work. Because trying to push integration very quickly invariably leads to the goodwill walking out the door. People don't like that change. They don't like to be told, for 30 years they had X person leading them, and then all of a sudden, somebody new's arrived with a new idea. It might be the right idea, but if you're trying to push that idea through without consultation, without really thinking about what's the best way to push it through, invariably some of the really good colleagues get challenged to accept those changes, and quite often they leave. And it's the same with customers. So what we tend to do is we tend to work with each acquisition and say, right, tell us what are the things that are wrong with this business. We know we've bought it, but we also know that every business has its own challenges and things that are wrong. And you'll be surprised by just asking that question, how many great comments and ideas you get out. And we then work with them to start integrating these businesses, right? Quite often, if there's an ERP change, we always insist that's done quickly because there are some fantastic synergies you get from common ERPs. But if there are some fundamental changes around management and structure, we tend to give it at least 6 to 12 months. Now, in terms of your question of have any of our acquisitions exceeded our expectations? Well, AW Lum has only been in the group for 2 months. They certainly succeeded our expectations on how strong a management team there is, how strong their market is. Looking at one of the acquisitions that we would have made earlier this year, Advance has been hived up and fully integrated, so that's slightly ahead of plan. And now the first implant of Advance into our Beaconsfield site, of which I think showed you an image, that will go in the next 60 days. So that's kind of ahead of where we would expected it to have been. Chris, any from last year that got?
Yeah, I mean, I think it's probably too early for them to be ahead of our expectations, but I think fundamentally we're very excited by what we've accumulated in the last 12 months. I think, as Shank said, particularly AW Lum and Advanced Roofing and Direct Heating. I think we see them as brands with real potential. They're complementary. There's great synergies, as we showed on the previous page, and over time you'll see their growth. I think if you look at the example we gave on Kings Langley and the example we gave on Beaconsfield, those 2 case studies, you see it's often a 3-4 year maturity. It's not that they're slow to mature, it's just that we have high expectations of, it's a significant maturity. We're talking about businesses growing by double digit, if not doubling, over that time frame.
Shankar, Chris, if I may jump back in there, that looks like you've addressed all of those questions that came through from investors this morning. And of course, if there are any further questions submitted today, we'll make these available to you immediately after the presentation has ended. And ladies and gentlemen, we'll publish all those responses on the Investor Meet Company platform, and we'll notify you by email when these are ready for your review. Shankar, perhaps for redirecting the investors on the call to give you their feedback, which I know is particularly important to yourself, Chris, and the company, if I could just ask you for a few closing comments to wrap up with, that'd be great. Thank you.
Okay. Well, firstly, thank you all for taking the time to listen to us today and allowing us the opportunity to present our business. We're really very excited about the opportunities that this business has. As you can see, over a 30-year period, we've grown this business to sizable medium-sized entity, and there's no reason why we cannot grow it even further. We are very focused on the operational deliverability of our business in terms of what we provide to our customers, and we are very much focused on ensuring we have an engaged colleague. We believe that we're entrepreneurial, but we're also highly professional, and that supporting our business will invariably be rewarding for our shareholders as well. So once again, thank you very much from myself and Chris, and we look forward to the future, whatever that may hold.
Shankar, that's great. Chris, Shankar, thank you very much indeed for taking the time to update investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Lords Group Trading PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.